Understanding the widow penalty can help you plan better and avoid some unpleasant surprises during an already sad and tumultuous time in your financial life. Hi, I'm Will Hoffman, founder and president of Hoffman Wealth Management, where we specialize in working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while creating the life that they desire. So, what exactly is the widow penalty? In simple terms, the widow penalty refers to the increase in taxes that a surviving spouse may face after the death of their partner. This happens because of the way our tax system is structured, and it can catch many people off guard during an already difficult time. When a married couple files their taxes, they typically file jointly, which often results in a lower tax rate due to the combined income being taxed at a more favorable rate. However, when one spouse passes away, the surviving spouse must start filing as a single taxpayer after the year of death. This change in filing status can push the widow or widower into a higher tax bracket, even though their income may not have changed significantly. Let's look at an example to illustrate this. Imagine a couple, John and Mary, who have a combined annual income of $100,000. While John was alive, they filed jointly and fell into the 12% tax bracket. However, after John's passing, Mary now has to file as a single taxpayer. Even if her income remains at $50,000, the tax bracket for a single filer changes, and she might now fall into the 22% tax bracket instead of the 12%. This sudden jump in taxes is what we call the widow penalty. The widow penalty can have significant financial implications. Besides the increase in income tax, it can also affect other areas like capital gains tax, retirement account distributions, and Social Security benefits. For example, thresholds for capital gains taxes are lower for single filers, which means a widow or widower could end up paying more in taxes on the sale of investments. Similarly, if the surviving spouse begins withdrawing from retirement accounts, those withdrawals might be taxed at a higher rate due to the higher tax bracket. Now, let's talk about another important factor: IRA required minimum distributions, or RMDs. Once you reach age 73, the IRS requires you to start withdrawing a minimum amount from your traditional IRA each year. These RMDs are treated as taxable income. When a surviving spouse takes over the IRA, they generally have two options. They can roll the deceased spouse's IRA into their own, or they can treat it as an inherited IRA. Rolling it into their own IRA may delay RMDs until they reach the required age. But once RMDs begin, they can push the surviving spouse into a higher tax bracket. This is especially true if the surviving spouse's filing status has changed from married filing jointly to single. Let's say Mary inherited John's IRA. If she rolls it into her own, she'll have to start taking RMDs once she reaches the required age. If these distributions are large, they could easily bump her into a higher tax bracket, compounding the widow penalty. Additionally, if Mary is already in a higher tax bracket due to her filing status, the RMDs will be taxed at that higher rate, reducing the net income she can rely on. Moreover, the way Social Security benefits are taxed can change as well. For married couples, a portion of Social Security income may not be taxable if their combined income is below a certain threshold. But as a single filer, the surviving spouse may find a larger portion of their Social Security income being taxable. Now, let's explore a potential strategy to manage this: a Roth IRA conversion. A Roth IRA is different from a traditional IRA in that the contributions are made with after-tax dollars and qualified withdrawals are tax-free. By converting some or all of a traditional IRA to a Roth IRA, the surviving spouse can pay taxes on the converted amount at the time of conversion, potentially at a lower tax rate while still filing as married jointly. This strategy can be particularly effective if the surviving spouse expects to be in a higher tax bracket in the future due to the widow penalty. Converting to a Roth IRA reduces the size of the traditional IRA, thereby reducing future RMDs and the associated tax burden. Since Roth IRAs do not have a requirement of distribution, this also provides flexibility in managing taxable income in later years. Let's return to our example with Mary. If she converts a portion of John's traditional IRA to a Roth IRA while she's still in a 12% tax bracket, she pays taxes on the conversion at that rate. Later, when she's filing as a single taxpayer in the 22% bracket, those Roth IRA withdrawals will be tax-free, and she won't be forced to take RMDs. This can be a powerful tool to reduce the widow penalty's impact over the long term. So, what can be done about the widow penalty? While you can't avoid it entirely, there are several strategies like the Roth IRA conversion that can help mitigate its impact. Additionally, working on lifetime tax planning rather than just your annual tax filing to adjust your income sources and tax strategy is crucial. For instance, if possible, you might time your retirement account withdrawals or capital gains in a way that minimizes your tax burden. Another approach could involve charitable giving, which can reduce taxable income. Contributing to a qualified charity not only benefits a good cause, but can also provide you with a tax deduction that helps offset the widow penalty. Additionally, if you're close to retirement, consider delaying your Social Security benefits to increase the amount you receive later on. This can help make up for increased tax burden you might face as a single filer. In conclusion, the widow penalty is a hidden tax burden that can catch many people off guard. While the emotional toll of losing a spouse is hard enough, understanding and planning for the financial impact can make a significant difference. If you or someone you know is dealing with this situation, it's crucial to seek advice from a tax professional and reach out to us to see if we can help you navigate these challenges and explore strategies like Roth IRA conversions.